I call on Government Order of the Day number 4.
Taxation Annual Rates for 2015-16 Research and Development and Remedial Matters Bill, first reading.
Mr. Speaker.
The Honourable Todd McLean.
Mr. Speaker, I move that the Taxation Annual Rates for 2015-16 Research and Development and Remedial Matters Bill be now read a first time. I nominate the Finance and Expenditure Committee to consider this bill. Mr. Speaker, the purpose of this large omnibus bill is twofold. First, it continues the government's work in supporting New Zealand businesses to grow by delivering the initiatives and the policy reforms that will help to create a more productive and competitive economy. Secondly, it focuses on the important job of maintaining the tax system over time so our tax rules remain clear, certain, current and work as intended for all taxpayers. With both these considerations in mind, Mr. Speaker, the principal items in the bill deliver important changes to ensure the current tax system does not get in the way of innovative start-up businesses investing in research and development. Proposed changes in the tax rules for research and development were announced in Budget 2014 and as part of the government's business growth agenda, focus on enabling business innovation. The first set of proposals of the bill deals with the timing difficulty for small innovative start-up firms. These businesses are often unable to use their tax losses in a timely way or at all because the tax rules require them to carry their tax losses forward to deduct against future income. This can pose a significant barrier to undertaking R&D for innovative start-up companies compared with those of larger firms, which generally have the ability to offset losses against existing income streams. For this reason, Mr. Speaker, the bill addresses this problem by proposing to allow eligible R&D start-up firms to claim up to 28% of their losses from eligible R&D expenditure in any given year. This cash out will be delivered in the form of a refund, and the losses cashed out will be capped at $500,000 for the first year, increasing by $300,000 over each of the next 5 years to $2 million. This proposed changes are intended to provide a temporary timing benefit only and may be thought of in the same category as an interest-free loan from the government. When the business makes a return on its R&D, it will be required to repay some or all of the amounts cashed out by either income tax paid by the business or from any gains on a sale. The proposed changes will apply to income years beginning on or after the 1st of April 2015. Further measures are designed to relieve a problem with the tax rules for businesses undertaking R&D with some development expenditure where some development expenditure is never able to be deducted for income tax purposes. This sort of business expense is commonly referred to as black hole expenditure. To deal with this problem, the bill proposes to enable capitalised development expenditure to be either deducted over time as depreciation or if no depreciable intangible asset is created, including when an R&D project ultimately turns out to be unsuccessful, taken as a one-off deduction upon write-off for accounting purposes. The proposals in this bill reflect submissions made in response to the government's initial proposals to deal with the problem of black hole R&D expenditure. Most significantly, the scope of the initial proposals has been widened to also provide tax deductibility for capitalised development expenditure on intangible assets with uncertain useful lives, if the intangible asset has been written off for accounting purposes. These proposed changes to the tax rules for research and development will be welcome news for our innovative start-up firms, Mr. Speaker. A third set of changes proposed in the bill will give taxpayers greater certainty over their tax affairs by clarifying the GST rules for body corporates. These proposals will give assurance to body corporates by confirming that services provided are supplies for GST purposes and give body corporates the option of registering for GST. This approach should give some comfort to New Zealand's 13,800 body corporates on their GST position. Registered body corporates will be able to remain registered, while those currently unregistered for GST will not be required to do so. This means the majority of body corporates will not need to take any action. There are also several rules, Mr. Speaker, to protect the tax base from the adverse consequences of body corporates being offered this choice. While these are the main items in the bill, further business-friendly changes are also proposed. These include changes to tax pooling rules to enable pooling funds to be used to meet outstanding interest liabilities arising from an amended tax assessment or resolution of a dispute, and extending the grace period for community housing providers that are removed from the Charities Register so they are not subject to the new tax rules on net assets. Other proposals focus on the important task of ensuring that tax rules operate as they should. These amendments reflect part of the tax policy process which reviews the law after implementation to identify any remedial issues that need correcting or clarifying to ensure the original intent is achieved. They include changes to strengthening the controlling foreign companies test grouping rules to prevent unintended tax advantages, as well as measures to clarify the tax treatment of income received by individuals from a superannuation scheme residing outside of New Zealand. Measures are also proposed to ensure that the intent of the Child Support Reform Scheme is achieved and focus Inland Revenue's effort on reducing child support debt, which is currently $3.2 billion and rising. This is the first time the system has been reformed since child support was introduced in 1991, and it will deliver a child support scheme that is much fairer to both custodial and liable parents and their children. Along with the changes proposed in the bill, it will also ensure greater compliance and a reduction of outstanding child support debt. There are also changes, Mr. Speaker, to Working for Families tax credits and the general filing requirements to simplify the administration and remove unnecessary requirements. This includes reversing the filing changes enacted in 2012, but which are not yet in operation. These changes will be dealt with as part of Inland Revenue's wider transformation program. Clarifications are also being made to the recently reformed tax rules relating to working for families, mixed-use assets, employee allowances, and to the livestock herd scheme rules. Collectively, these changes recognise the importance of maintaining the tax system for all New Zealanders. It's the result of much consultation, review and reprioritisation by the government with businesses and taxpayers so that our tax system remains current and continues to support New Zealand's economic growth. Mr. Speaker, I commend this bill to the House.